Hello everybody, welcome to Know Your Money. I'm Bronwyn Wayner.
And I'm Craig Finch, and we are from Growth Financial Planning. We hope you enjoy our podcast. Welcome everybody, Sean Hanlon from Brightrock, Executive Director. Thank you for your time once again.
Thank you, Craig.
And we were chatting about there's some unique parts of your product that at age 65 cover can continue without paying premium. Is that correct?
That's correct. Okay,
Please explain that to us.
Sure, Craig. Thank you for asking the question. It's called the premium settlement option. So there are two other companies that offer it, and don't ask me that. I'm not going to market for them. Okay, but ours is quite unique. Okay, in that for example, the other two companies you have to take out the policy at 65. With us, it can be from age 55, as long as you've been paying premiums for 15 years, because obviously it's pre-funding. So in other words, we're funding the ability to be able to not pay premiums but continue your cover when you're older, which makes a lot of sense, right? Because if I'm older, my big focus there is on my pension funding.
Yeah.
So paying my life assurance policy, okay, is actually, and especially one that's premium is compounding away, becomes quite onerous when you're older. So you effectively are paying a higher premium during your younger working years. And for us, from age 55 onwards, okay, if you then retire and your premium settlement option kicks in, your cover remains then level at whatever it's grown to at that point, but you then stop paying premiums.
So can you retire early at 58 or whatever? You don't have to be 65.
No, you can
whatever day you choose.
You can stop that premium from the age of 55.
Yeah.
It doesn't have to be at 65.
Correct.
Okay.
As long as you've paid for 15 years, because that's how we fund it.
50 years prior. Yeah.
Correct.
So that's a great option, because a lot of clients in retirement have this life policy and they go, what am I going to do with it? Why should I lose it if I pass away? My children could get it.
Yes.
But now somebody's got to pay for it. So
exactly.
The kids start paying and they think, well, I hope dad doesn't die, but be quite nice maybe if he does die, because I get all this money. So
I sort of get that impression on a regular basis in my house.
But so this takes that out the equation completely. At a determined, let's say at age 60, you stop paying premiums and your cover continues.
Yeah.
Does that include severe illness?
Yes, that does.
Okay.
But one of the things that I also want to talk about, if I may just grab the opportunity, is we've spoken in previous series about funding patterns, okay, and we take great pride in letting people understand what a funding pattern is. Because, for example, what if I'm a farmer, as an example? It's a very big seller for us, and I've got two children. Okay, the one child is going to take over the farm. She wants to farm. The other child,
it's a she. Well done.
Yeah, the other child, he's going to go play music in London. Okay, all right, and I'm the farmer. So I want to be able to leave the musician, okay, the equivalent value of the farm, okay? So I don't know. I don't know if you've got kids, but you try and treat them fairly, but sometimes very difficult. But the reality is that we can take out what we call a pre-funded funding pattern, and that's where I can pay a higher amount of premium today, but my premium remains level, but my cover grows by 4%. Okay, so you then pre-funding it, so you're paying 30% more for the next 7 or 8 years. But over the premium paying a lifetime, you're saving millions of rands.
And also you're doing that while you are making that money.
Correct.
So you can actually afford to do that.
Correct.
30% a little bit higher now.
Correct.
And then have that benefit later on in 10 or 20 years.
Brian. And for a business owner or a farmer, as an example, having predictable cash flow, is so important, but at the same time their cover is growing. So that ability to be able to have funding patterns that can flex according to people's needs, okay, is also incredibly unique to Brightrock. Other companies' funding patterns, people don't even really understand them. And I've said it in previous sessions. What will your premium increase be next year? Okay, I can't, in my record of advice, as an advisor, I can't put in there, okay, what it will be, because it's illustrated. So you can't, with good conscience, say what it'll be. And that goes back to previous sessions where I spoke about that certainty pillar, inside the product.
Yeah. Awesome.
The other thing that companies do is they talk to you about getting something back, okay, and often that's quite misleading. because if I claim on the policy, which is, by the way, why I took out the policy, it's a risk policy, okay? It's not a pension planning policy, okay? I can affect that cash back, okay? We've built into our income protection what we call a change moment payout, okay? And that change moment payout kicks in, okay, on your given retirement age, when you no longer need to protect your income. You've accrued an asset in your product that even if you've claimed on the product, the asset sits there, and it pays you out, okay, an income amount over a 10-year period, okay, an income amount, not a lump sum.
How's that calculated?
So we calculate it up front. It's actuarially calculated.
Okay.
And it's obviously built into your premium. And it's as I said, it's automatically embedded inside your income protection policy. So not only are you paying less to protect your income, not only can you protect your income accurately, okay, you can predict how many paychecks you've got to protect, as we've discussed in previous series. But at the same time, if I get to that retirement age, okay, I've got an income a pension booster that's paying me out an income amount for 10 years, okay, to supplement my retirement planning. And that's incredible because it's not a cash back. Okay, it's not. It's a change moment payout.
Yeah. So how I can describe it is, let's say you've taken out that policy and, sorry, what's the term called when you stop paying the premium?
Your retirement date.
No.
Premium settlement box.
Yes.
Yeah.
Okay. So you've taken out your policy and you've chosen now your premium settlement option. So at age 65, you stop paying for that cover, but your cover stays in place. And then you get this change in moment payout, which will give you, let's say, R1,000 a month. So you are really helping your retirement and ensuring that your beneficiaries can still get your life cover, because you're not now paying 10,000 Rand for a life policy that you can't afford. So it really does work well if you position that properly with the clients. So for example, if I am giving client cover, I would take out, say, 2 Brightrock policies. So I would take out one that will go for life on certain things and another one that will have that settlement option. Because the amount of cover a person needs when they are in their 40s and having 4 children is very different to the amount of cover that they need then. But you do still want to give your beneficiaries something because you've paid all this money over time. So you really can work it well.
With people's income being dynamic throughout their career, is there like a review process?
It would be underwriting again.
So Warren.
So let's say you go from being a 25-year-old to suddenly a CEO of a big company at 45, 50.
So I'm so glad that you asked that question, okay, because it talks to another extremely unique feature, okay, that we have in our product. Other companies have a similar features, but they are watered down and are subject tos, okay. And as I said, I'm not here to market for other companies, but the reality.
You shouldn't. Yeah.
No, I won't. I did. the reality is that when we underwrite you, okay, because you ask a great question, yes. So let's just talk about a business assurance need. Okay, so for example, I've got a contingent liability with a bank. Okay, so I've got a 10 million Rand loan, and the bank obviously wants collateral on that loan in the event of my death, okay, or disability. So I take out a life assurance policy. So if I go to any other life company, I'll buy a policy, okay, and they'll cost me to age 110, okay, not for 10 years, okay. With Brightrock, okay, you take it out for 10 years, okay. So let's say it's 5 million Rand, as for example. We underwrite you in bands of 10 million. So now let's say your premium is 1,000 Rand, and your benefit's not going up because your loan facility is 10 million, okay, it's not increasing. But now we come along and we go, you know what, we've got a business opportunity that we want to take, okay? We want to increase that liability, that loan, by another 3 million Rand, okay? But my blood pressure's increased, okay? Because you're running a business, okay? It increases, okay? At the end of the day, we underwrite you in bands of 10 million. So I took out a policy for 5 million Rand, but I've got access, okay, to another 5 million Rand of medical underwriting free cover. So because I've now taken that loan from a 5 million Rand loan to an 8 million Rand loan, I can then go to Brightrock and execute what we call the extra cover buy-up of 3 million Rand free, okay, of medical underwriting. And that is unbelievably unique.
Is that a one-time step, or can you continually do that?
You can continue to do it, to do it. Up to that, 10 million band. And if you take out 10 million and R1, we underwrite you to 20 million. Okay? Up to 30 million. Okay? And what we do now is that we actually provide a facility for our advisors where we actually contact the clients, okay, on behalf of the advisor. We don't give advice. We just say, you have this facility available to you. Would you like to take out more cover? Okay, and we've got a 70% take-up rate.
Very good.
Where people take out their cover. And I often say to people, they go, oh, no, you 5% cheaper or more expensive than a competitor. The first thing I do is look at the funding pattern, okay, because they're not comparing apples with apples, okay, right? Because if we say the policy goes up by 5%, it goes up by 5.
Yeah.
Okay? It doesn't go up by 11. Okay, I mean, it was interesting. The other day, I was doing a presentation in Nelspruit, and I showed a competitor quote. I said, "Yeah, this policy says that my benefits go up, my premium goes up by 5%, my benefits go up by 5%." Turn over the page. Absolutely, the benefits went from $1 million to $1,050,000. Okay, premium, turn over the page, illustrated 11%. Okay, so there's often a lot of the times misleading. Okay, in terms of those funding patterns, but when I get into a situation like that, if we are slightly expensive, I say, but you need to go and add on another 5 million rand. Because you're not just buying 5 million rand cover with us, you're buying 10 million rands worth of cover, but you're not paying for it today. Yeah. You pay for it when you need it.
Like when you need it, yeah.
And it's an extremely powerful benefit.
You give them access without having to go through the whole process.
Spot on one. Yeah. Absolutely correct.
Yeah, that's good, yeah.
Awesome. Thank you, Sean.
Great benefits. Thanks for sharing it with us.
Thanks, Greg. Yeah.
Thanks.
Thank you very much.
That was a good one. Thank you for listening. If you have enjoyed this podcast, would like to subscribe, please visit our website, www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.